on time. We'll start the recording now. And excellent. Well, let's get started. Happy Financial Fitness Friday. Figured first thing, talk about what we're talking about here today. Bottom line, I think it's important that everyone knows kind of whether they're on track for their retirement goals and execution. And of course, as humans, we all seem to want to compare ourselves to each other. But it's really all that matters is your own personal situation. Personal finance is personal, but these are, I think, some good metrics that help see it if you're on track, and then maybe get if you're not on track, then hopefully this is important. The sooner you can find out, you can start making the necessary adjustments to get on track. And by the end of this, hopefully you'll have a good sense of where you're at based on your age and income. And it's a thumb rule that I use, that use from the Millionaire Next Door. Their average accumulator of wealth and Prodigious accumulator of wealth formulas. And also, I hope people will start tracking their net worth. I think that's a very valuable thing to do. And it's actually kind of motivating, personally, I find, to see as your net worth goes up, it kind of helps you even save and invest more. But before it gets started, we'll go to the next slide, the disclaimer. As mentioned in the invitation and discussed every other time, this is for educational purposes. It's not sanctioned or supported by Biosat, and none of this is should be construed as advice. But hopefully, this is a discussion, interactive discussion that you find helpful and useful. And also want to make sure, can everybody give me a thumbs up that they're okay with me posting this on YouTube? I'm not paying anybody. I don't get any money from it. It's just that everybody can, that can't be here can get a chance to view these as well. And Gordon, okay, excellent. Hannah,
yeah, I'm good on.
Okay, thanks, Ian. Hannah and Josh, I didn't see, or Nathan, we might have already done it. Thank you. Thank you. Okay, great. Okay, and I'm going to launch a quick poll right now. These should just take a second, but okay, looks like is anybody still working on it? Okay, I'm going to end the poll now, and then we'll go over the results. Okay, and sharing result. Okay, I asked about this, and that's what I was curious about. We're talking about 401k and net worth in this discussion, and that's why I brought up umbrella insurance, because I think that's important. It's all of us have car insurance, probably renter's insurance or homeowner's insurance, etc. But those there's certain required minimums that you have. But if you are involved in an accident, or say, like the whole liability if somebody tripped at your home and, bust their head, they can come at you and sue you way above what those minimum insurance requirements are. And so for a small amount of money, you can buy umbrella insurance. You have to have the other insurance first, though, but this will go on top of that insurance and cover you for you can get several $1 million worth of umbrella insurance for like $100, $200 a year. It's really something everybody should have to protect yourself from getting sued and in case, who knows, you get in a car accident, whatever. But this is a very important thing to have, is umbrella insurance. like I said, extremely affordable. And you should, for the next question though, I guess I'll note these since you can't actually see them. I remember on the recording. Second question is, what is the basis for the amount of your umbrella insurance? And 4 out of 13 said value of sum of all your assets. 2 said amount of your total debt. 3 said your net worth. Some said 4 out of 13 said just some dollar amount, not based on anything specific, which is it's common. Really, it should be based on your net worth, though. That way, it covers you, and they cannot come after you and take your own, take the things you've worked hard on for what could be a small accident that that you don't want to have impact your whole life. Okay, next question is, do you calculate your net worth on a regular basis? 2 said quarterly, 4 said annually, 3 said monthly, 4 said never. Personally, I think monthly is a bit excessive myself. That you're just kind of, but some people just love that, like accountants probably. But quarterly is what I like, or annually. And if you don't, I've got a net worth tracker. We'll go in. We'll show here if anybody's interested, if they don't have something that they use. But I like it quarterly. You can see on a regular kind of recurring basis how your net worth is changing. And then, do you have a Roth IRA? 7 said yes, 6 said no. The people that said no, do you have a traditional IRA or no IRA? I saw one head shake for traditional. Hopefully, I'm a big fan of the Roth IRA for reasons I've explained before, but we can go into that as well. But okay, thanks. Any questions on the poll or umbrella insurance and why I even brought that up when we're not talking insurance?
Where do you buy that?
Yeah, just where you like I go through USAA. That's who I have my car insurance and homeowners insurance through. So whoever State Farm or whatever, who's your normal insurance for the other typical insurance that you have, you just get that an umbrella policy. And that's where you need to know your net worth though, since that's what the amount that you want that value of umbrella insurance for. Okay. Good question. Thanks. I was actually thinking that, DC, I should have said, where do you get that from? But, okay, here's the agenda. Hey, what's the difference between average, like the mean, and median? And what should you typically use when you're thinking about finances or home purchase price, home values, et cetera? What do you guys, anybody want to respond? Not everybody all at once.
Well, an average would be taking everybody's into account, and it's highly volatile based on upper and lower values. Yep. And a median is basically the 50th percentile, where you've got 50 values above, 50% of the values above and 50% of the values below. So a lot of times that's a better unit of measure.
Exactly. Absolutely. That's perfect, DC. Thank you. And so median, you go from smallest number to the largest number, and then that number right in the middle, that's the median. The average, or the mean, is you sum everything up and then divide by the total number of participants or houses, whatever. And so it's like she said, it really gets skewed. And you'll see when we go through these graphs how the top 1% of income earners' net worth totally skews that average way up compared to the median. And the best thing typically is to look at median. But as you'll see when we go through this, I want people to be at the 90th percentile. So I also put numbers for those figures as well. So we'll start moving through. On these though, what I did put is both. So every year, Fidelity and Vanguard put out average 401k balances by age. It kind of frustrates me that they use a whole decade. That's kind of ridiculous. Like there's a big difference between people 20 to 25 and people 26 to 30, but this is what they give. So this is what we get to deal with. But they do provide median and average 401k balances. And as you can see, Fidelity has like 21 million people. So it's a good representative sample. Vanguard, they have 1,700 plans for nearly 5 million people. One thing I thought was interesting, though, they do say that this I thought was higher than expected. The average contribution rate was 13.9%. That includes employer match. So if based on that, if hopefully everybody here is doing at least 10% on the 401k contributions, so that you get the max 5% match. But that would be so that would be 15% based on the numbers they're doing. But you look at these numbers, are these, going to provide? Granted, 401k is not the only asset, but it's over 75% of people. This is their most significant, retirement asset. But he's 65 plus, 200k, 280k. Is that enough to live on another 30 years? Not the lifestyle I want. What's that?
I said I would guess no.
Well, it depends. All depends on your expenses, but anyway, and here's just graphically you can see, and now note how how much different the average is compared to that median, and that's based on that 1%, which you'll see in a second. I'll show these. We'll go into average incomes across the U.S. and you'll see what a difference that 1% makes. So this is average income, and this is based on people working from January through December of 2020. That's the latest statistic that we actually have. COVID year, so kind of an interesting year, but it showed just a small drop, relatively speaking. I think overall 3% in some areas, but just look at how much that 1%, that top 1% is just so so different, but you can see how that's going to impact the average. And then here's just the numbers, and like I said, I highlighted the 90th percentile. I want hopefully all of us are at the 90th percentile or can get to the 90th percentile or better. That's I don't want to be average. I don't know about you guys, but why I'm putting up income is should let the bumper at the bottom. If your income's above average, shouldn't your net worth be proportional? Too often and we'll get into it, but you see people that have a lot of money or have a lot of income but don't save anything. This I just couple of quick graphs I found that I thought was interesting. This shows the breakdown of average household incomes against the states. I'm sorry, I know it's really small, but it goes from 70,000 to 140k. Mississippi being the lowest down there, about 75k, and then Connecticut being the highest income. I'll break you see a little bit better here, but this is kind of the lower half. You see the average is about 100k for this is household income, and Texas is right there at and then we'll go to the next one. That's where you see there's Texas and California and New York are about the same at 119k, but then it bumps way up. Maryland, Massachusetts, New Jersey, and Connecticut are 130k plus. Kind of interesting. Not just not don't even spend any time on it, but I thought found it interesting. Okay, so what is net worth? How do you define that? You're muted. If tell me, I sound like you were saying something, but.
Oh, sorry, I was talking to someone else actually. But
Okay.
net worth, I mean, anything that can count as money. So whether it's your house, or the positive part of your house, your savings, stocks, so on and so forth. Okay.
Yeah, which those are your assets, right? What about your liabilities? How does that go into net worth?
Just subtract it from your assets.
Yep, exactly, Josh. It's so your overall net worth, and that's where we're talking about the umbrella insurance. Even if your home is worth, let's say, home is worth 500K, but you owe 300,000 on it, that difference is only 200K. You only need to cover that 200K in umbrella insurance. Does that make sense? So it's not just the total value of your assets. You'll just pay a little too much if you don't count your liabilities. So it's really, assets minus liabilities is your total wealth and is your net worth. What I put up here is, here's a balance sheet. A balance sheet is really your net worth. And businesses have this always, but this is a personal balance sheet. Got your cash, your investments, your property, your retirement accounts, various things, and then minus all your debts. And that net worth is what your real total value is. The next sheet, the income statement, that's your income and what you bring in, what goes out. And the big question though is, are you income statement rich or balance statement rich, and which one's more important? Anybody have any thoughts on that?
Can you read the question, please?
It's what's more important to be quote income statement rich, high income, or balance statement rich?
I would say balance statement.
The balance statement.
Absolutely, exactly. Because you could have the highest income, but if you're just living the high life and don't put any away, you're still poor. Net worth, your balance sheet, your assets minus your liabilities is what brings real true wealth. And as an example of this, think of professional athletes. Within 2 years of retirement, 78% of NFL players are either bankrupt or in financial distress. In the NBA, 60% within 5 years are in the same way. I mean, these people are making so much income, yet there's definitely a variety of reasons why athletes, get in these situations. But I mean, it's just terrible. So you've got a balance sheet, net worth, that's what's important. Here's what I just pulled up this is what Charles Schwab, they have a good little page that says, here's how to add it up, and then they provide a net worth worksheet. But there's certain things that I'll ask, and kind of curious how you would track your net worth. What specific type of numbers do you use? So do you include your car? You can. I don't personally. I'll go into that, but especially when you're young, I would say yes, that's one of your major assets. But it's a depreciating asset, so you got to remember that, and it keeps falling down. Plus, it's a use asset. But what value of your home do you use? Do you use like Zillow or Redfin, or do you use your purchase price? And do you differentiate between liquid and illiquid assets? Like your home, your car, all that. Those aren't liquid, especially the home. And then what do you guys have a guess? What the next thing?
So Alan,
yeah,
a question. So on your vehicle,
yep.
Even if it's paid off, you don't consider that. I know it's a depreciating asset, but based on the book value,
you absolutely should. I just don't, because it's so insignificant, and it's just, to me, it's just a use asset that is depreciating, and so I guess to me it's just kind of insignificant as far as what I'm trying to track in net worth. I'm looking for the value of my asset that's going to take me to financial freedom. Does that make sense?
yep.
I mean, doesn't it depend on if you're able to sell it, really?
Absolutely. And
So-
yep.
I guess a couple years back when used cars were getting bought for pretty expensive prices. I mean,
They are right now too, and that's going to change though. Give it a year or so, and that whole craziness of used cars going up in value won't be the same anymore. But yeah, technically you should use it. And especially when people are young, I would say add that in, because that's one of the only assets probably people have young. But as you get older, hopefully that a car is completely insignificant to your net worth. Unless you have some like classic cars or something like that, that could, that are more like, that would be worth something later. But Chance, does that make sense? I just absolutely use it. I just don't. When people are 40 and over, I'd say if you're really, relying on your car as part of your net worth, you got more concerns than.
Yep.
Hey, so any guesses on what is the average in the US, what fraction of some household net worth is in their home that they live in?
So what it should be or what it is?
What, good question. Both. How about what it is and what do you think it should be?
I think it should be maybe around 25%, and it probably is around 80%.
That's good numbers. Josh, it's actually about 70% typical. And especially though, Josh, like on the coast, it's harder not to have that skewed because home prices are so expensive here,
Right.
but I agree. And looking at the experts, they say that it should probably be about 25 to 40%. But and then my question is, would you be happy if 70% of your net worth is just in your home because it's illiquid? How are you going to, is that going to allow you to retire unless you just sell it and move somewhere else cheaper? It's just
It's not going to pay medical.
it's not going to exactly, so.
What about a reverse mortgage?
That we can get into that. The reverse mortgages are very costly, and that is a way. Another thing is, Brian, people can use their home basically as their long-term care insurance. That's another way. But if you have to get into a reverse mortgage, that's unfortunate, I would say. That is an option, and there's some that are probably getting better, but this is also, home's also a way to, maintain some generational wealth as well. Wouldn't you rather be able to, pass this on to your heirs, and they get a step up in value? But yes, that is an option, but don't get taken for a ride on a reverse mortgage, which is most common, seems to be what happens.
What's the difference between a HELOC and a reverse mortgage?
So actually, so reverse, Hannah, I think I could be wrong, but I think your question is more, what's the difference between a HELOC and a home equity loan? Because a HELOC is a home equity line of credit. And so that's one that it's always an adjustable rate mortgage typically. And what it is like a credit card for like 10 years. Basically, you can use as up to a certain, usually like a certain percentage of the equity that you have in the home, like 80%. And you can, so let's say you get a home equity line of credit for $200,000. You can take out $10,000 at a time, do some renovations on your house or do whatever. You can use it for other things besides actually renovation, and then pay it off, and then use it as like a credit card almost, or like writing checks. Whereas a home equity loan, you get a loan for, say, that $200,000, and it's a loan, you've got all 200K and you start paying interest on all of that right now. Whereas a HELOC, you're not paying anything unless you actually take money out and have a balance present. But a home equity loan is typically a fixed percentage, fixed rate. So it's typically a little bit better than a HELOC, but you're paying, you're paying on that entire balance, the interest on it. Does that make sense?
Okay, yeah, that makes sense.
And a reverse mortgage is what people take the equity in their home and basically you're slowly kind of selling your home away to the bank. You're using equity in your home to provide your income. And that's usually people, fortunately not too many people do that, but that's elderly people typically that haven't saved enough in their retirement, and they need a source of money. Any questions? I didn't define that very well. If anybody wants to explain more, but I wasn't planning on getting into reverse mortgages exactly.
No, that's still helpful. Thank you.
Okay, thanks. Okay, great. Here, and now I'm just explaining, this is just how I do it. I'm not telling anybody, but I break down my assets based on tax-free, tax-deferred, after tax, and real estate. And I think, and then I make a pie chart out of that so you can see. Home value, I use purchase price. And why I do that, I actually do two tabs on my thing. One with the market value, which I use the lower, Redfin's usually lower than Zillow. I use the low end on that. And then I take only 93% of that. Because if you're gonna sell your home, you're paying at least 7% on average, in closing costs and, fees associated with that. So I don't think you'd ever want to use 100% of market value because you wouldn't be able to get that if you sold it. But I use purchase price because what I want to see is how what I'm doing, saving and investing, paying down the mortgage, how that's improving my net worth, not by just what the crazy COVID market did, temporarily. That's not maybe realistic always. And so to me, it's how I can better see tracking of what I'm doing to get towards financial freedom. Does that make sense? But you do need to know the market value because going back to that umbrella insurance, you want to cover, cover that. I don't include the car, like I said, and I don't include jewelry. I mean, I just put that in like, hey, can we go sell that necklace and put the earrings? How's that going to go over? No, and do people really sell that? Usually that's just passed on into the family, gifts. So to me, I just don't do that. You still should have that number for, insurance purposes, but mine tracking is really for financial freedom. And this is what my network tracker looks like. On the left, you see, I kind of broke it down so you can kind of see, but there's cash, there's taxable investments, Roth, traditional, other, like if you have HSA. These aren't my numbers. I just threw in a couple example, columns, and then this whole thing goes out columns so you can track this over many years. Your child savings, charities, which I don't include in my net worth because that's not for me, that's somebody else. But I keep track of those numbers. It just doesn't go into my bottom line. And then I look at homes, debt is the liabilities, and then totals. So I have total being total net worth, and then total FI, financial independence assets. So that's the liquid asset that I can stay in my home and live, but that's what's going to provide lifetime income, towards retirement. And then on the bottom, I like to see what the change is. So this will show like what your monthly change in net worth is, even though you do it only quarterly. And then you see the pie chart there that breaks down the various buckets. And then on another tab, I actually have a graph that shows what these things are doing over time. And if anybody's interested in this, can provide this, but any questions there?
That's a great table.
And you can modify it however you want. I kind of added things as I wanted to see them over time.
Did you say you were going over Roth versus traditional in this?
I wasn't planning, not on this. I can't,
Okay.
Josh, and I've done that. One of the presentations I already did was on Roth versus traditional and lifetime tax management.
Oh, okay.
So, but we can, any if you guys have questions, please ask, and then I know what things people want to learn about. Okay, now we'll go into the averages of net worth. This is all these are all based on federal studies, and there's a good website, I think it's DQ, I'll post a link for it, that provides these, over every couple of years, they show this information, provides the income and the net worth. And once again, I'm showing the top 1% here, and you can see just look at how, significant difference that is, but at least hoping we can get to the 90th percentile. And these are average net worth based on the various ages. And then I'll break these down into smaller segments, age groups.
So if you're married, would this count as both of you, or is net
These
worth
are
like,
actual, Josh, yes, these are actual household incomes, but
okay,
what household net worth, but what I would say, especially if you're a married couple, both working, then I look at these as your individual salaries, and if you're both working, then this should be doubled. You know what I mean? You
Right.
should use both those incomes. Does that makes sense?
yeah,
I feel like I didn't speak that well, but yeah, those are household net worth, but I'm thinking much more on the individual basis here, because I know, like, looking at the incomes, hopefully a lot of people are already, they're above the average income, and then hopefully above the average net worths as well. But here's just the graphical display that doesn't include the top 1%, but you see the blue, the largest, that's the 90th percentile, and significantly higher than the rest, which is where I hope everybody is at or achieves and exceeds. Now, just breaking it down, here's 18 to 39. You can see where, the 90th percentile, the median, and median average, and then I show the lower 25th and 70th as well. And then just okay, 40 to 69. These are the averages that we've seen. You notice it's right about 55 to 60. That's when people peak out, and then probably a lot, hopefully, are retiring and starting to spend down. And there's just the numbers. And if people, stop me if you need anything. So, what is the average age for when millionaires obtain their first million in net worth? What are the studies shown? Anybody guess? And how long does it take? Josh, it looked like you were going to say something.
I'm thinking maybe
Okay.
like 45 to 50 or something.
Good. I'm not going to let you answer anymore. Yeah, Ian, you were going to say something as
I
well.
just said mid 40s. I mean, just based on the data that you're presenting right there, like.
Yeah. It's actually, it's about 49 is the average age. And it takes normally about 28 years. And you think about it, like, on average, people graduate college, what, about 22? Then you work, so the point is, especially for the young folks, it takes time to build wealth. Be patient, it'll come, so long as you take the right steps and are saving and investing. But it's, you're not going to go like TikTok. I think like one of the worst things for this, but be patient. It'll come, and just be diligent, and it'll come. But okay, now we'll go into as we get into examples. The formulas I'm using are from the Millionaire Next Door, which they have what's an average accumulator of wealth, which is basically your age times your income times 10%. But for people young, and these formulas skew, like, they make it harder for people that are younger, because obviously your age, you haven't been working very long. So if you're 20 times, say 22 times the sudden first income out of college, you're not gonna have likely that much net worth. But, and I think the Money Guy show, they actually devised to make it better for people under 40. They added, instead of just being divided by 10, it's divided by 10 plus how many years until you're 40. So it gives some catch up time, since people are just really starting to work. And then there's the example, and we'll go into specific examples using these median and 90th percentiles. But this is just average. Do you guys want to be average? This is their prodigious accumulator of wealth, and basically it's 2 times the average accumulator of wealth. And this is what they've shown is people that become millionaires, and are become wealthy are prodigious accumulators of wealth. And so this is where like kind of like I feel like the baseline of what you want to meet or exceed. With the fire movement, they're saving even at a much higher percentage. So they would, be more like probably 4 times this instead of 2. Anyway, I think this is a good formula to use to see if you're where you're at and on track. And then we'll go into based on, I'll go back to, these are the various incomes. What I did, since they only showed like 25, 35, 45, I took the different, I averaged out and figured out what would it be for 30-year-olds, 40-year-olds, et cetera. But that's why those numbers are in italics, because I just, averaged the 25 and 35, et cetera. But, and then we'll go into the next one. These are, for 50 and above, those are the incomes as well, median through the 90th percentile. Now, here's some examples. And if people want to go, as we flip through these, if you have specific ones, and I think you can annotate on the board, like I know people probably want to be anonymous, but if you have specific age and income, you want to see what these numbers would be, let me know. I've got the formula, the Excel right here to run some numbers. But this is an example for a 25-year-old. I've got the formula there for average accumulator of wealth and prodigious accumulator of wealth. The median income, the top 2 rows on each side, those are the data that's, just provided. That's, the median net worth is that based on, studies by the Federal Reserve. Median income, that's what, what it shows. And then the AAW and PAW are what I calculated based on that median income and the age. And what's the average accumulator of wealth? What's the prodigious accumulator of wealth? And then over on the right,
Alan,
the 90th percentile. Yes.
do they break down this by state by any chance?
So, well, what I did, I don't know if you, let's all go back to it. They have broken down average incomes by state,
But not the median and the 90%.
I haven't seen that,
by
and
age too.
maybe they probably do, but it's like I haven't been able to distill through enough. I mean, to see that it wasn't easy enough to find, but I bet they do. But you could, I guess if you they probably wouldn't even break it down well enough that you'd want to see what's the difference between San Diego and Modesto. They're both California. But income and net worth are probably way different. But they do have the average incomes for those states, and like the average household income in the U.S. in California was like 119,000 and change, which I don't know, you might have not been on yet, but I had just a little graphical that showed the states and how their average income was.
Yeah, and I saw that, but I like the age breakdown.
Yep.
I think it's helpful.
I'll see what I can find, but this is what best I could find at this point.
No, this is great. Thank you.
Okay.
Thank you.
Okay, any questions here on what's being displayed? Like what I wanted people to be on the right side if they can, the 90th percent, and the PAW, the prodigious accumulator of wealth, are better. But you notice the prodigious accumulator of wealth is nearly matching what the 90th percentile net worth is at. It's pretty interesting. That's just the data from studies. But then this formula. So I think it's pretty good. Here's for a 30-year-old. And like I said, if anybody has specific numbers or anything they want me to crunch, we can throw those up. I've got a few that in a few slides. But this is a 30-year-old, and I'll just keep moving along because 35-year-old, 40-year-old, 40-year-old. Hey, Ian, like you were saying, the prodigious accumulator of wealth at the 9th is already a millionaire, which that's what I hoping to, help people get to as soon as they can. Get that number from 49 to 40 or better. 45-year-old. $50-year-old. So if you see your these incomes, if these match anywhere near you're at in your age, I think it finds a provides a good baseline of where you're at. 55-year-old. Six-year-old. A 65-year-old. That's as far as I went up to. Here's another number. This is they show actually in the CFP courses of thumb rules for how much what your net worth should be based on your age and gross pay. And that uses various things, but it's another good thumb rule to ensure you're going to have a decent retirement. Hopefully you're 55-year-old, you're 10 or better times your salary, and then early retirement is an option. 45 and 55. Okay, so here's a few examples. Additionally, just put up. Anybody have some specific ones that they want to look at? These were just, age of 28, somebody making 67,000. Here's what an average accumulator would be. Here's what a prodigious. And like I said, these are, it's when people are young, closer to when they're below 40, these calculations are a little more challenging to meet, but as you get 40 and above, they hopefully should not be. Anybody have anything else they want? I see a chat too. I don't know.
Shouldn't your net worth grow larger the older you get?
Yes, but Josh, what about though, as you like you see those on all those graphs, once you retire though, you're starting to spend down, right?
Right.
And
but even like from 30 to 50, like it seems, according to these, like pretty stagnant. Like shouldn't when you're around 50 it grow, a lot larger than it when you're like 35?
And it probably should, but so should your income as well. And yes,
right.
I agree. And that's where I think is as these get older, it's kind of interesting. I think this formula, I was just looking for a good general formula, but yes, I think it should, because I think you also should be putting at least 25% towards your retirement, and or better, more if you can. And then these would dramatically go up at a higher clip. So it'd be more like 2.5 times that, but I was just trying to find a good,
just a general formula or something.
Good general formula that you could use to see where you're at. But I agree. Yes, as you get older, and hopefully as your income's improving, you're not just constantly, raising your standard of living, but you're, putting a decent amount of that aside to that you can choose the life you want long term. Any other questions? Okay, now if you're ahead of the curve, I said check lifestyle, because if you're just a miser and all you're doing is saving, well, maybe you should enjoy life. You need to enjoy life. It's a balance, but keep going. Same time, like, this provides freedom, which is what you want, the ability to do what you want, when you want, with who and how you want. And it also then allows you to take the pedal off down the road, sooner, rather than trying to stock away too much more later. Any questions here or thoughts? Okay, and then what if you're behind the curve? This is where I get concerned with and people start taking unnecessary risk. I'm going to throw all my money in crypto or something. No, it's okay. Take a breath, and don't go into higher risk just because that could turn out to be very negative. So stay disciplined, but then, hey, time to review spending. Maybe get a side hustle. The big three are food, transportation, and housing. That's where the majority of expenses are. A lot of people talk about the latte effect. Look, going to Starbucks, yeah, you shouldn't do that every day, but that's not where your is making a big difference. Big difference typically is in the housing costs you're paying, transportation, and food. But Starbucks does fall into food. But I'd rather focus on the big things than the small things. Couple of things, we talked about this before. I think, Christian, didn't you say you checked your subscriptions and started saving like $100 a month or something like that?
Yeah, I saved like 140, I think.
140. So if you guys haven't, do that. Check your subscriptions. It's something everybody should do. You know, whether they're ahead or behind the curve, every 6 months or so, just to get rid of unnecessary things. That it's amazing how much all those little things add up. And then a few things. Has anybody used cash instead of a credit card for purchases? It's amazing how much harder it is to give up cash. I really consider, like, do I really want that? But there's credit, like, yeah, here, tap. It's even easier than, you know, inserting. It's so easy to spend money in credit cards. So if you're, try cash for a month, try the 72-hour rule. We're so, you know, spoiled by convenience. Well, do you really need that? Wait 72 hours to see if you really need something, you know. And anyway, it's really about being more intentional, but not getting scared. And then, like I said, it's, you know, you only live once versus being a miser. Strike the right balance. You know, to people that say, hey, I'm only going to be here, you know, I don't know how long I'm going to be here. Well, your likelihood, you are going to be here for a very long time. So let your future self take care of that, you know, take care of that person. But at the same time, don't, you know, live now as well, and make sure you're enjoying life.
Hey, Alan.
Yep.
You ever considered doing a course on using credit cards to your advantage? Because there's some advantages to, you know, for example, you know, putting expenses on a card, but paying it right, only if you can pay it off right.
Exactly.
And accumulate rewards and points, which can pay for a vacation as opposed to having to.
No, absolutely. We'll do that. And there's good resources online too that have those courses for travel hacking, etc. But yeah, we'll do that. That's one down the road. But you're absolutely right. Credit card use, I'm a fan of. Credit card debt, no, you should not have a balance. Pay it off every month, but you can totally pay for a vacation or more per year just with smart use of the credit cards and bonus points. Let's see. Okay, so and Alyssa, kind of like what you mentioned, we are in a high cost of living state, and you know, so it's tougher here than you know, heck, what San Diego took over San Francisco as the most unaffordable area in terms of housing, you know, recently. But it still comes down to especially probably those big three, regardless of how much your income is. If you're not putting some away, you're not building real wealth. Okay, and then this, I put this slide up before, but you saw those numbers, and Josh, kind of you were saying, hey, as you get older, shouldn't it go up? Well, I ran just some numbers saying, hey, if you put, and that's what our current 401k limit is $20,500 a year. But you can also do a Roth IRA, that's another 6,000, you know, not counting catch up for people if they turn the year they turn 50. But if you just contributed 20,500 a year for 30 years, twice, you know, assuming, you know, biweekly paychecks, and an 8% rate of return, which is a good, you know, it's kind of a standard rate of return for equities. This would be, you're going to have over $2.5 million. And then it can continue to grow, you know, by double, you know, like that doubling, you can get, you know, almost another million in less than 10 years, even if as you get more conservative and your rate of return drops down. But yeah, yeah.
I was gonna say, is 8% like the average, or where did that number come from?
That's a typical average. Actually, Josh, what I like to use is, in general, if you're all equities, is 7%. But they say like what the market returns, like S&P 500, or really that's only a fraction of the market, but that's a lot of times consider that. But 8 to 10%, but 8% is what people typically use for an overall, you know, total market stock market, what the overall market returns.
Okay.
But what they've shown, and it's kind of what for the last 100-something years, if you were all equities, your after inflation adjusted rate of return is 7%. So really, I think the return has been about 10% because inflation's been overall typically about 3%. So that's why you need to invest in equities, because it's equities beat inflation. Bonds don't, cash doesn't. That's why you need to be in the market. And it's
Right.
typically return. Yeah, this is a bad year. Inflation's high, market's down. That happens. Now it's a great time. Keep putting money away because it's down and it's going to return. I'm optimistic there. And so now it's time to buy it cheaper and it'll return at much greater. The lost track of what I was gonna say. Oh, but that 7%. So, and to me, Josh, that's what I like to use, because I can't think in tomorrow's dollars. But if you're counting an inflation adjusted return, you can think in today's dollars, and it doesn't matter. It's 20 years down the road. Does that make sense?
Yeah, that makes sense.
So to me, that's the best way to think about it, that my tiny brain can handle. Okay, and then just going back into, like, I talked about this before too, but how much do you really need to retire? Like Susie Orman was like, oh, you need 10 million. It totally depends on your expenses. And there's Bill Bengen and the Trinity study came up with a 4% safe withdrawal rate. So, and that's inflation adjusted, and it's a rule of thumb. I wouldn't use that. There's better ways to distribute money as you start to spend down. But this showed that using the 4% rule of thumb, which is basically having 25 times your annual expenses in assets, 96% of the time you would not run out of money in 30 years. If you're retiring early, most people recommend a kind of a smaller lower percentage. Like, if you're retiring at 40, you probably want something more like a 3% safe withdrawal rate. But this is based on having money in equities, and this was like a 50-50 equities and treasury bills split was what the initial study was. But overall, the years they looked at, you would and I think something like 50% of the time your money would be 4 times as much instead of actually ever running out. So, but it's just always having an idea where you need what you need. And as long as you're not constantly moving the goalpost out further. And then everybody knows the rule of 72, right? Or maybe not. But it's a simplified way to calculate how many years it takes your money to double. And that's not counting, additional contributions, but you take 72 and divide whatever your rate of return is. So like we were talking about 8%, Josh, 8 into 72 is 9 years. So your money will double in 9 years if you get it, and that's one of the things I don't like so much about like target date retirement funds, because I think they go conservative too soon, and you miss that last doubling, which is the most important doubling. So, and I think too often people, but unless they have just so much money they can go super conservative, that's fine. But in general, I think those go too conservative too fast, and you miss that final doubling that really is what you want. In general, people from age 20 up to 85, you can have 6 to 7 doublings of your money. In your 50s, you still could have 30 to 40, 3 to 4 doublings, based on where life expectancies are now if you don't go too conservative. So, and then the book, Design Your Life, money's a tool, but this is a good book talking about, hey, what do you really want to do with your life in general? And that's what, once you have money is a tool, but if you don't have a plan, doesn't matter if you stop working. A lot of people get depressed. Any questions? I think that's I guess a couple questions I had for you, but any questions you guys have for me?
What was the name of that book again?
Designing Your Life. And there's a designing your work life. I haven't checked that out, so I can't validate that, but it's probably good. I think it's designing your new work life is their latest one.
Hey, Alan,
So,
what was
yep.
the first book you mentioned right at the beginning? Something about Millionaire.
Oh yeah, the Millionaire Next Door. So that's where I got this formula for the Prodigious. And they did there's a next Millionaire Next Door as well. And he's Thomas Stanley. Unfortunately, he passed away. I think he was in a bike cycling accident. But his daughter finished up the next Millionaire Next Door, and it validated everything they did 20 years prior as well, that 80% of millionaires are self-made, got no help from anybody else, you know, and all these other things. And but they're good books that show tried and true, you know, methods of what real millionaires in America have done. So any other questions?
Will this PowerPoint be somewhere accessible?
Yeah, and on that link, I'll put these out, and
Okay.
then once I'm done, I'll also stop the recording and post that on that YouTube link as well.
Awesome, perfect.
Okay. Any other questions? Here's some upcoming potential topics. I'll put out a poll or something, but if anything stands out, let me know right now. Otherwise, any other questions?
Yeah, just nothing on the chat as far as today's session. I had one other topic idea to throw up on the board. I mean,
Yep.
I'm saying it's in any priority or anything like that, but just kind of a topic around what do kids cost? How do you budget that?
Yep.
I mean, is it $1,000 a month? I mean, for some of the younger folks here, like
Yeah.
at least I don't know. So
No, that's a good, and one of the topics was, you know, investing for kids, but that's a good question. They say it's typically like 250K, I think that's what they said, which to me, I think it depends completely on the area where you live. But yeah, that's a good topic. I'll bring up, and you just made me think of something. It just slipped my mind, but no, that's a great topic. Oh, this was it. I've heard this several times recently. People, sometimes they're waiting until they have so much money till they have kids, and then they regret it later. Yeah, you might have a little more bumps in the road with kids early, but having them in your life, that's how like significant, how wonderful they are in addition to people's lives, that they wish they hadn't worried about having enough money, you know. You'll get through it. It was an interesting perspective, I thought, because it too often, like, I think you see, you know, people are having children much later and later, and I thought that was a pretty cool perspective to hear, though. Anything else?
that's it. Oh, here we go. Someone, Christian, just put dollar cost average versus lump sum. Why you prefer indexes to individual stocks, and common investor biases are interesting topics.
Okay, sweet. Actually, I wish I could there we go. And
would that go into
perfect.
Common investor biases?
Yes. Which one?
Like, you had a question on like indexes versus individual stocks, basically. Would that go into common investor biases? Like, I
think it's kind of its own topic in a sense. Okay. I would add that in there because there's like herd mentality and some other things that are common biases. Yes, they are. But I have a specific thing, like I'll bring a topic that I'll just discuss why I think indexes versus individual stocks, and I'll go into life cycle of a business, etc. And just why investing should be boring. You can play a little cowboy money with 5 to 10% and buy your individual stock or crypto or whatever you want. But in general, my recommendation, you know, my thoughts are buy the index, keep buying it, and just let, you know, it's self-cleansing and will bring you wealth.
Do you have any specific S&P index funds that you prefer, or just a spider, or?
You know, it doesn't matter. I'd say I like the total market indexes. So it basically they're weighted, but like Vanguard has, you know, VTSAX is the mutual fund version, VTI is the ETF version, and that's the total US stock market. So it's weighted about, because of the size of the companies, 75% of that is the S&P 500, the 500 largest companies, but it also includes another 3,000 plus companies. So you've got all the CEOs in the US working for you. Same thing, you could do another fund, a total international market fund. And then you maybe get some, which has, does everything outside of the US, but I wouldn't, I'm more US centric, so I'd put more in the US. But those are relative. And then small cap value, that's historically beaten. It's more volatile, but beaten both of those. So a good small cap value fund for, depending on your age, but 15 to 30%, and maybe, some emerging market. Bam, you've got the whole world covered then. Anybody have any thoughts on that? I know I just kind of like spewed it. Like I said, these aren't advice or recommendations, but those are things I like. Keeps it simple, and a few things. Keep it simple, stupid. That's what I think is a great philosophy.
Are you aware that the HSA we have did like a reset? So if your funds got liquidated back to cash, so you had to reinvest your HSA indexes recently.
Yeah, good point.
Yeah, that is a good point. Today, I actually did that this week. It's really easy to do. It's through the same portal as well. And the market just took a dump, so might be a good time. Yeah.
Yeah, now's a good time as the market's, now it's time to buy in, let that recover. They say on average, after a decline like this, the next year, and no prediction, but it usually rebounds about 33%. So I think it was already a little bit high. I think that's aggressive, but hey, buy while it's low. It's going to return. Companies are going to continue to innovate and make profits. Okay, well, I'm going to stop the recording. And any other questions?